So we're going to work on quite a laundry list of things here, which will cumulatively build on chapters 1, 2, and 3 in addition to 4. So Miller acquired Taylor, 80% of Taylor, so there's non-controlling interest, NCI, involved because 20% of the subsidiary is owned by outside interest. And Miller paid $664. The remaining 12% had a value of $166. So that means that we can't use the assumed fair value being $664 divided by 0.8. When it's silent about the value of the non-controlling interest, you can do that. But here they actually give you the dollar value of the non-controlling interest, so you would add those two together to get the total in order to see the difference between fair value and book value and assign it to assets and calculate goodwill, should we be asked to do that. All right, on acquisition date, we have a book value of $600,000. Taylor's buildings were undervalued by $80,000 with a 20-year life. All right, so the first thing is, what's the excess depreciation expense annually for the consolidation? So the building being undervalued by $80,000 would be divided by 20, and so the annual amount would be $4,000. All right, so that would be A. What about goodwill? Okay, so now we actually have to do a little schedule here, map out. So the fair value would be that 664 plus the 166. That's the presumed fair value of the whole thing. And then the book value is $600,000, which they give you. And so then the difference, the fair value over book value, is that difference. And so that difference has to be allocated to either items that have a fair value in excess of book value or to goodwill if there's for any that are not. So we have, they tell us about the buildings, and those were undervalued by $80,000, so the difference must go to goodwill. So the 230 less the 80 that were identified, so your goodwill here would be the 150. Now they would like some journal entries. So here I've set up kind of the bones of the S entry and the A entry when there's non-controlling interest. So the S entry would remove common stock. If there was additional paid in capital, it would remove that, and then the beginning retained earnings. And then you would, the other side of the, add these three up, 80% of that will be credited to the investment, and the other 20% would go to non-controlling interest. So let's do that. So what is the common stock here? All right, so common stock we need to eliminate is of Taylor, the subsidiary, is $300,000. Paid in capital is $900,000. Now we need beginning retained earnings. So let's go on up here. And so beginning retained earnings they gave us was the 210. All right, and so these three things, they add up to $600,000. So that $600,000 is going to be times 0.8 and then times 0.2. Verify that that adds up to 600,000 so that our entry balances. So there is your S entry. Now what about the A entry? So the A entry is to step up the book value to the fair value for assets that were identified or to goodwill. So the building has to go up by the 80 and goodwill has to go up by the 150. And then these are added together. That 230 is going to be split 80-20. And then you can verify that your entry balances, and it does. So that's what they're asking for in C here, the S entry and the A entry. And that's for year 1, the end of year 1. All right. Now they want the investment income in year 3. All right, so let's work on that. All right, so the investment income that's going to be on the parents' books is going to be 80% of the subsidiary's net income and 80% of any amortization of the fair value over the book value. All right, and so let's do the math here. So the net income for year 3 is 100,000 times their 80% share, and then that amortization, that 4,000 a year, which was the 80,000 divided by the 20, we're going to get 80% of that. So the investment income for year 3 will be the sum of those two. 76.8. All right, great. Let's see what they want next. So now they want the investment in account at the end of year 3. So now let's make a little T account. Hang on, I'll draw that for you. All right, so here's an investment in Taylor T account. So the initial purchase was $664. So we would have debited the investment in and credited cash for that initial acquisition. And then for each of the 3 years, we would record their 80% share of net income. So we can do that for each of the 3 years. And we would reduce it by 80% of the dividends. So let's do that. I'm just copying down the formula, but that's 80% of 10, 80% of 15, and 80% of the 20. Same thing here, 80% of the 70, 80% of the 90, 80% of the 100,000. All right, so the investment account went up by the net income. It goes down by the dividends, but it's also going to go down by their share of that 4,000 that's being amortized of the 80,000 excess of fair value over book value on the building. So the 80,000 divided by the 20 years times 0.8. And that's going to happen 3 times. It's going to happen in year 1, it's going to happen in year 2, it's going to happen in year 3. So the investment account at the end of all this, sum of all the debits minus the sum of all the credits, is going to be $826,400. So that's all 3 years together. All right, going back up here, they want to know what would the building account, the consolidated building account, look like if the book value at the end of year 3 for Miller was $800,000 and the book value was $300,000. Okay, so let's do that. All right, so the book value of the parent, they said, was $800,000. Book value of the subsidiary was $300,000. All right, and it's going to go up by this excess fair value, but it will have been depreciated 3 times by the end of year 3. 4,000, 4,000, 4,000, so 12,000. So the consolidated account is going to be all of those added together. Oh, that was 80. I got an extra 0 on there. There we go. All right, and then it asks for the ending balance at the end of year 3 in common stock, additional paid in capital, and retained earnings. So that's a little bit of a trick question because the consolidated equity section is always the equity of the parent. All right, there was a lot in that one. Let's go on to the next.